Family trusts have been the go-to structure for Australian business owners for as long as I can remember. And there's good reasons for that. But I think the landscape has shifted enough that it's worth challenging whether trusts still deserve to be the default. So I want to show you what's changed, the problems I'm actually seeing right now with real clients, and what I recommend instead for most business owners. Let me start by giving you some context on why trusts became so popular in the first place. Because it wasn't by accident. A family trust gives you the ability to distribute income to different family members each year. And that's the core feature. And 20 years ago, that was genuinely powerful. You could distribute $6,000 to each of your children tax-free. If you had 3 kids, that was $18,000 tax-free. And 20 years ago, that was a decent chunk of income. You could distribute to your parents, to your spouse, to your adult children. Each year, you could look at who was earning what and send the income to whoever was on the lowest tax rate. On top of all that, you had asset protection. Assets held in a trust are separate from you personally. So if something went wrong in the business, your investments were shielded. And the trust didn't die when you died, so there were estate planning benefits too. So it made sense that trust became the default recommendation for business owners. The flexibility was real and the benefits were tangible. But that was 20 years ago. And since then, the ATO has systematically stripped away most of the flexibility that made trusts worth having. You can barely distribute to minors anymore. Because the amounts are so small, we actually don't even bother. Distributing to adult children, parents, or other family members is now firmly on the ATO's radar under Section 100A. Their view is that if you want to distribute to someone and the money doesn't actually end up with that person, if it doesn't actually hit their bank account and get used for their benefit, they can reclassify the entire distribution and the trustee pays tax at the top marginal tax rate. We're talking 6-figure tax bills for what people thought was just normal trust planning. And it's not just Section 100A. The ATO announced 7 compliance targets for 2026, and trust income splitting is one of them. They've gone from being relatively relaxed about trusts to actively targeting them. It's like the government has weaponized the ATO to go after trust structures. So think about your own trust for a second. Are you actually distributing to anyone other than yourself and your spouse? Because if you're both in the top tax bracket, there's nobody left to split income with. You're paying for the trust, the compliance, the annual returns, and the only people receiving distributions are you and your partner at 47%. The trust isn't doing what it was designed to do. Besides the distribution issue, there's a second problem with trust, and that's it has to distribute all of its income every year before 30th of June. It can't hold profit the way a company can. And that one rule is the source of nearly every problem I see with trusts in practice. In a company, if you have a great year and you make $1 million in profit, you pay 25% tax and you keep $750,000 in the business. You decide what happens to that money and when. In a trust, you don't have a choice. That $1 million has to be distributed by the end of the financial year. So you distribute $200,000 to each spouse and the balance goes to a bucket company. That sounds fine on paper, but here's where it goes wrong. The money has to actually go into the bucket company, not just on the tax return. The cash has to physically move. And in a lot of businesses, it can't because the business has already used that profit to reinvest, buy assets, or pay down debt. So what happens is the accountant does the tax return showing the distribution was made to the bucket company, but the actual cash never left the trust. Under the ATO rules, that unpaid distribution gets treated as a loan from the bucket company back to the trust, and that triggers Division 7A, which has strict rules about loans between related entities. Every year, that keeps happening and the problem compounds. I had a client who had a business and multiple properties inside a trust. Every year, the trust made a profit and the old accountant was distributing it to a bucket company on paper. But the money wasn't actually moving because it was tied up in the properties and the business kept reinvesting it. By the time he came to us, he had a huge Division 7A problem worth well over $1 million. And the only way to start fixing it was to start selling down properties, which triggered capital gains tax and stamp duty. I had a similar situation with another client whose trust was buying into private property funds. These tend to be illiquid investments, so you can't just sell your units whenever you want because you're locked in. But the old accountant was still distributing profit to a bucket company on paper while the cash stayed in the trust. Same Division 7A trap. We're now waiting for those investments to mature so he can sell them and move the money across to the company to clean it all up. And then there's what I call the lumpy years problem. I've got a client with a business in a family trust that had a great year, made $1 million in profit. We distributed $200,000 to each spouse and the balance went to a bucket company at 25%. But the next year, the business only made $200,000 and the business needed that cash from the good year to reinvest and pay down debt, but the trust had already distributed it. Anyone running a business with lumpy revenue, whether it's trades or professional services, farming, anything with boom or bust cycles, this is a real problem. Now, the distribution issue is usually the biggest problem for most business owners in a trust, but there's another one that catches people off guard when they want to grow. If you want to bring in a partner, a key employee, or an outside investor, a trust makes it incredibly difficult because it can't issue shares, sell shares, or set up an employee share scheme. I have a client who runs an architecture firm and it was set up in a unit trust. To bring someone in, they had to restructure the entire thing into a company and then swap the units for shares using a rollover. This was a high cost to do that and a lot of admin and not to mention the risk. Another guy who actually watched one of my videos was buying into a business. He wanted to pay $450,000 to buy in, but the business was in a family trust. You can't buy into someone else's family trust. So now they're looking at a full restructure to a company using the small business rollover plus the stamp duty costs. And then there's a complexity issue, which I touched on in this video. I actually had a startup come to me recently and their accountant had recommended a trading company, a separate IP company, corporate trustees for each founder, unit trusts and family trusts. And in total, there were 10 entities for a business that hadn't even made $1 yet. I mean, it's good for the accountant. They've got 10 sets of fees to charge, but it's not really that great for the business owner. So if trusts create all these problems, what should you do instead? Because you still need a structure. You still need asset protection, tax efficiency, and the ability to invest surplus profits. We manage over $250 million in equities portfolios for our clients. Out of all of that, about 5% is held in family trusts. The rest is roughly half in super and half in companies. And the reason is that when I run the numbers for business owners doing 1 to 5 million in revenue, the company structure wins almost every time. The way it typically works is you have a trading company running the business with a family trust as the shareholder. The trust still has a role here, but it's the shareholder, not the entity operating the business or doing the investing. Then the company makes a profit. You pay yourself and your spouse what you need, and the balance gets divided across to a separate investment company, sometimes called a bucket company at 30%. Now, sometimes we need the structure to be a bit different depending on the situation. I had a client recently who had a trading company, and inside the trading company, they had accumulated $3 million in cash. But the shareholders here were two individuals. Now, we can't get the cash out without paying a dividend and the individual's paying tax at 47%. So what do we do instead? So what we can do here is insert a holding company. There's a rollover for this, and what it looks like is you end up with a structure here where you have the holding company and it owns the shares in the trading company. The individuals now own the shares in the holding company. So the dividend can now come down into the holding company and the cash can be held down here like this after the dividend comes down. This then allows the holding company to reinvest that $3 million without it being at risk of the trading entity and its activities. If they get sued, then basically they've still got their holding company, which has now got the assets held separately from the trading entity. And instead of the $3 million being taxed at 47%, that holding company has a tax rate of 25%. Now, I want to be clear about something. I'm not saying every business owner in a trust should rush out and restructure tomorrow. Changing from a trust to a company isn't always straightforward. There can be capital gains tax, stamp duty, and genuine risk involved in getting it wrong. And even when you can do the change using a rollover without triggering tax, there's still a heap of admin to get through. So we don't always change it. Sometimes the trust is working well enough and the cost of switching just doesn't make sense. But if you're starting a business from scratch, the answer for me is a company every time. And if you've been at a trust for years and you're dealing with any of the problems I just walked through, whether it's Division 7A exposure, forced distributions causing cash flow issues, or a structure that's stopping you from bringing in new people, it's worth getting an honest review of whether what you've got is still the best option. Because in my experience, most business owners never actually compared the two side by side. They've just stayed with what was set up for them. If you want us to look at your situation, there's a link below to book a call with our team. Otherwise, if you want to go into more detail about why I don't recommend trust to clients anymore, check out this video. See you over there.